Mike Muller, head of Vitol Asia. Good morning and welcome back to the table. You told us last time, more or less, pointed in this direction firmly. Do you think this keeps moving from here?
Well, it's come $2.50 last week and about $2.50 the previous week as well. So it's not an unrestrained rally, but yes, markets have very high implied volatility at these levels. And we've moved from a market that at the end of the year seemed a little bit to be in the risk-off mode to people now seeming to take a greater interest in the energy complex. But the bit I like to come to straight away here is fundamentals, because there are a lot of people saying that, I've heard some of your podcasts last week, for example, suggesting that maybe there are fundamental signs of that are mixed. And my view is that it's a very resolute positive. There are reasons why the market is backward at the front, and so backward, so much so that the market is telling you, be careful, don't be short, because you're one disruption, one refinery wobble away from markets getting even stronger. So whether it's the backwardation in the distillate market, whether it's the fact that jet fuel is trading at or above gas oil, whether it's the backwardation in crude, these are all a manifestation of tightness at the front, where there is a scarcity or a perceived scarcity of supply, which has not been helped by a combination of many refinery closures in recent years for reasons we know, plus unscheduled refinery issues, plus certainly in Europe, the need to factor in higher gas prices and carbon prices into refining margins. So refining margins are telling you that refineries should be running flat out because product cracks are at levels we haven't seen for many, many months. And as a consequence, that should be pulling very hard on crude markets. And inventories continue to sit at levels that are worrisome. And then we'll start talking about where the spare capacity is. And the pace and rate of investment in the US is not quite what it was before. We're still nowhere near the peak that we saw pre-pandemic in terms of US production capacity. And the spare capacity in OPEC Plus is really down to 2.5 or 3 members now. And month after month, the 400,000 barrel a day that's being put on the market is actually, in effect, a much, much smaller number than that. Which leads us to a point in time, and we can debate whether it's second half of this year or sometime next year, OPEC spare capacity reaches levels that are considered alarming. And so much so that the debate has now swung to how soon we need Iranian supplies to help alleviate the situation, or whether there's indeed a need for more SPR, because the wave of SPR releases that Joe Biden's administration initiated over a month back were, with hindsight, just a small event.
Mike, what are your thoughts on that sort of analysis that's coming from many, that this is a year of 2 halves? The first half will be tight. The second half it'll ease off. We had the US CEO of ConocoPhillips over the weekend saying, warning that people are underestimating how much US oil production could come back this year, as much as nearly 1 million barrels as part of that easing in the second half. Your thoughts?
I didn't read the ConocoPhillips CEO's comments as a warning. I read it as just a factual statement. And I think it was another 800 to 900,000 barrels a day of US shale production, which is the very least people would have expected. If you put me in a time capsule and sent me back a year and said, if the oil price were at $75 a barrel, how much extra production would you see in the US? I would have given you his number. We're at 90 something. So I think with WTI through 90, those numbers are reasonably modest, and they are a reflection of conservatism and the prioritization amongst oil majors, even the listed US majors, to not put all their eggs in the shale and indeed in the oil basket in this time of energy transition. So yes, I don't subscribe to the view that it's a year of 2 halves where the second half is weak, except everybody is building into their balances for the second half the return of Iranian crude. And it's really a question of when. And administratively, even if there were to be a reconciliation and an agreement to drop sanctions, the return of Iranian crude is not foreseeable in Q2, even under an express outcome. So one has to assume this is a second half event. And then it's a question of what sort of rate of ramp up is. And I think most observers will be aware that there is a floating inventory of unsold oil on ships that have been commonly referred to as, the floating flotilla of South Pass condensate largely. That would obviously get released into the market somewhat quicker, and then the rate of ramp up will also be reasonably quick. But the fact that it is in people's balances already and has been, without exception, every investment bank, every advisory consultant, every oil major, they all have a view that Iranian oil will be back later this year, and the forward market is still, the world needs that oil.
As well, but also in the context of China's import appetite at these prices. There was some indication the price sensitivity there. They've got a lot of strategic reserves. They're more likely to draw on that than pay $90 to $100 a barrel in the open market. Your outlook for China oil imports?
Indeed, if I can just start with gas and that map you
Please.
flashed up, it's quite interesting. If you just visualize that map, there was no connection between the East Siberian pipelines that can feed into China and the rest of Western Siberia and Russia that feeds into Europe. And until such time as the European side, let's say the West Siberian side, is connected to the infrastructure, there'll be no political leverage that a Power of Siberia 2 pipeline is to serve as a leverage to force Europe to pay higher prices. Otherwise, China will take the gas. However, there on that map, there was also a pipeline coming in from the Sakhalin 2 and 3 project in the north of Sakhalin Island, and there was talk about making a connection from that through Mongolia into China also, which would be an interesting one. And the Power of Siberia line is that one you see that ends up where it says towards China. So yes, it is great rhetoric, but it's a massive expanse of Siberia there, and there's an east and a west to it. So that point is worth highlighting. Now, as for oil, I mean, all the headlines have been made on gas of late, but there have been comments that China has been hoarding and building inventories of oil. I think it's fair to state that China is at bare minimum operating level in terms of the prescribed levels of mandatory stock holding that the state-owned enterprises are meant to hold. And we've spoken many times about the government measures to further restrict the operations of the independent sector, sometimes referred to as the Shandong teapots, also some of them further north in the province of Liaoning. But I think all eyes on what happens in China after Chinese New Year, because there is a feeling that some restocking will be required. And if you look at the spot behavior at the very front of the market, it doesn't look like they've had their foot off the pedal. Up until the very last day before Chinese New Year, the Chinese state-owned enterprises seemed interested in buying crude at these prices. So I don't think China is as price sensitive as South Asian nations are. And again, drawing parallels with gas, it was very telling that when LNG prices went to unprecedented levels a month or two back in December, South Asia just did what it did earlier in the year as well. It went on buying strike. It just stopped buying, and the consequences means that factories reduce operation in things like textile sector, cement sector, and the lights go out for rolling brownouts across cities, whether it's Pakistan, India, Bangladesh, etc. But no such thing from what we can tell in China. And let's also remember that China has the ability by policy to just force the coal sector to ramp up dramatically. But coal prices aren't sitting still either. They're at all-time record levels again, not in China, but certainly elsewhere. Not helped by the disruptive export policies of Indonesia, which tried to strong-arm exporters into putting supplies to the domestic utility first and paying penalties if they didn't do so. So all utility markets are currently pretty strong, and all eyes on the weather. And indeed, as Christoph said earlier, we've seen in previous years what cold weather in Texas and Oklahoma and places which are oil and gas producing can do to that sector. That, of course, is the underpriced market so far, but the world is relying very heavily on gas exports from the US Gulf to balance a perceived need by Europe. So it all hangs together a lot. But I mean, China had what they called Chinese New Year travel rush, which was up 48% versus last year. It's still down on 2020, which we must remind ourselves, there was a problem in Wuhan, but there wasn't yet a travel restriction for Chinese New Year 2 years ago. So it's still down on 2020, but it's very much up on last year. And colleagues of mine in China are not under any pressure not to go visit their relatives in other provinces. There's relative freedom to travel, albeit.
Are you remaining somewhat bullish that imports this year will exceed last year? We won't see another year of declining imports.
There's a massive question on that, because we saw the Chinese refining system go to 15 plus million barrels per day, and people are forecasting it won't go there again. But we've got extra refineries on stream, right? Shenghong is a brand new refinery. Rongsheng's ramping up, and its phase 2 wasn't fully in place for the whole of calendar year 2021. So China has to and will run more because these are integrated petrochemical complexes which are designed to have a margin and designed to run at 100%. And they will have to build the inventory and the line fill that goes with all this. Plus, of course, There will be strategic inventory, line fill, unit fill for all these new units, which is going to consume extra oil. And I think the same goes for natural gas. I mean, in China, year to date has had people raise questions whether China will repeat the massive increase in LNG demand, which we saw 2021 on 2020. There is a view that ought to be the case, but there were some very confusing signals put out just 2 weeks back when some SOEs came out with major LNG cell tenders, although they ended up seeing an uptake for those LNG cargoes that was much less than they tendered out, so just a fraction of the cargoes they said they were going to sell. But it is just demonstrating the muscle that Chinese SOEs can flex in all energy markets at the moment, be it coal, be it LNG, be it oil.
Welcome your thoughts on this point. It becomes the question of demand destruction. And is it something that we have to think about in 2022? You said other areas of Asia a little bit sensitive to the pricing of energy now. What's your outlook for energy demand destruction with hydrocarbons, in particular oil and gas, at these levels? Mike, you're on mute, sorry.
My apologies. It's an extremely confusing picture on this demand elasticity point. The point I was making was relating to LNG, which in oil terms went to $300 a barrel or something ludicrous. It's unthinkable for oil. So, I mean, let's just remind ourselves, the world was at $110, $115 a barrel for nearly 4 years solid, from 2011 to 2014. That's just 7.5 years ago before the price correction occurred then. And if we go back and model how much demand destruction occurred there, and what the impact was on the economy, the market's been there before. And yes, of course, there is some sort of view on this. I heard one of your Aussie commentators on Thursday comment about behavior in Australia where people refuse to drive if the gasoline price goes to a certain level. Yes, there's an element of that, but I don't think it's anything compared to what's going on with people's household electricity gas bills, which is eating away at people's disposable income also. So yes, lower middle income and low income strata of even the Western world, let alone the developing and the emerging markets world, will abstain from consuming quite as much energy as before, given what's going on. However, I don't think it's a linear thing that kicks in at $90, $95, $100 a barrel oil. I don't think that's so noticeable.
Well, I mean, if you look at what's just announced on Bloomberg this morning in terms of the OSPs for March, I mean, up 60 cents on Arab Light. It's chunky enough for Europe or for Asian refiners.
Yeah, I've got them up in front of me here. I mean, that's exactly spot on with expectations. So for once, the OSPs from Aramco didn't surprise, and that's the Asia number, of course. But you saw very chunky increases in the Western Hemisphere, which is basically Aramco saying we can find enough demand in Asia, which is a high price market anyway. So I think yes, it's up, but it's got to be up because month on month you've had a massive increase in backwardation, and the backwardation feeds through into differentials and into the OSPs in a very logical manner. So yes, it's up. It looks bullish, but they're not telling the world don't take our oil or anything like that, or we only want to sell to top tier customers. They've done what the market expected this time around.
What other distortions are in the market at the moment because of the continued erosion of inventories?
Yes, as I said at the outset, diesel is a good one to focus on because of the cold weather and the lack of inventory. And just a few refinery incidents have tipped this market into a very steep backwardation and disincentivized anybody to store, made it very expensive for people to blend, and also disincentivized people from taking long voyages and doing long haul voyages, because why pay the backwardation if you can go to a local market and sell at a small discount than going to the other side of the world? So yes, we've had a couple of refinery issues dogging Asia. For example, the latest one was the issue around the operation of the KPC joint venture refinery in Vietnam. And there were a couple of other issues around other parts of Southeast Asia. And we mustn't forget, of course, refining capacity is down. I mean, we've got Singapore refinery of Shell running at half its usual rate. The same company closed their refinery in the Philippines, and we've had a conversion in New Zealand of the only refinery there to a product import terminal. That sort of trend aggravates things when there's less slack in the supply chain. And if you throw on top of that a good dose of COVID-affected port agents and lines workers and pilots, and crew changes being hampered by these things, everyone wants to plan to have adequate supply in the system. Throw in a dose of cold weather, and let's again look at the news, and you'll see that it's all the way down to the southern states, Texas, etc., in the US, and we've seen what that can do in the past. It is potent, and it is telling the market, be careful, don't be short at the front of the market, because just one incident away and we can get even bigger backwardation, and shorts could get very, very badly impacted as they seek to exit their positions. So the other issue is the market is still relatively risk off. The commitment of trader reports and the general index of managed money being in the market is still nowhere near where you'd expect to see, given some people consider oil to be a good inflation hedge. And is that money going to be tempted to come into a market which has a positive roll yield of more than $1 per barrel per month backwardation? One has to suggest perhaps yes, as the stock market looks a little more jittery and the fundamental picture on oil is a very resounding thumbs up. Demand is currently making the headlines and supply is the problem. So I think the fundamental message is pretty attractive to money markets who appear to be on the sidelines still. And whilst there is a risk in a market that has very limited open interest that, the sell side starts talking the market up to 100, etc., it does look pretty robust, but implied volatility in options markets is at record levels we haven't seen for a very long time. And we've seen earlier in Q4 that the market is capable of $10 a barrel pullbacks, all of which then get put back on in a matter of weeks. So it's not for the faint-hearted.